Thank you, Ignacio. That was a wonderful lecture and fully lived up to the promise. I thought I'd just say a few remarks about Per Jacobsson. Ignacio's already talked a little bit about him. He was an internationalist in every sense of the word, first with the League of Nations, then at the Bank of International Settlements, and then as managing director of the IMF. He saw trade shutting down during the Great Depression, saw it re-emerge after World War II, and played a vital role in encouraging the reintegration of the world. So I think it's fit that this lecture have somebody like Ignazio Visco talking about how institutions performed at one of the gravest sort of times in our history. And I think his verdict is pretty well. And that gives us a hope for the future. So we have an excellent panel to talk about the questions that were raised by this lecture. And let me introduce the panelists. Roberto Campos Neto, Governor of the Central Bank of Brazil since February 2019. François Villeroy de Galhau, Governor of the Bank of France since November 2015. Andréa Maechler has been Deputy General Manager of the BIS since 2023, and John Williams, President of the Federal Reserve Bank of New York since 2018. Roberto, the floor is yours.
Well, thank you. First, I would say that we miss you, Ignacio. I was thinking the other day that you left and then Tomás is going to leave, so nobody's going to ask questions anymore. So, François, we have to find a different way to do meetings from now on. And also, François said here I'm on the extreme left today, so I have to behave better. But I tried, on this, I tried to look at the clippings going back to the times of the COVID to see what could I add to the wonderful presentation. It was obviously that we started this prepared for a depression, and we actually faced a recession. One thing that was very interesting when I look back in the clippings was the estimation of the recession or the depression was very intense. For Brazil, the estimation was that the GDP would fall by between 9 and 10%. And a lot of these people who were doing that were estimating this based on models of mobility. So people at that time were looking at the Google mobility and trying to say, if you have less mobility, what it means for growth. And we got that completely wrong. And it was not the mobility that was wrong. Actually, we got the mobility somewhat right, but the people had the ability to do more with less mobility. And I think that's one of the lessons that we learned on that. The other thing is when you look at the slide 7 that we had here in Ignacio's presentation, which is basically a trend line for goods and services and the shifts that we had, when we go back into the clippings at that time, you had, and you have for US, but I had this for other countries too, you had the shift in demand for goods, and then you had the lowering in the demand for services, and the interpretation at the time is those things would converge very fast, and they didn't. And if you look in your graph and many others for other countries, you're still above the trend line for goods until now. Now services, you're converging a little bit. But I think at that time, that was responsible for part of the interpretation of the transitory. That we're going to go back into this equilibrium of services and goods, and that took much longer than we expected. The second thing, when looking back at the clippings, is that we had a demand, increasing the demand for energy, and I think probably we failed to understand that when we shift from services to goods, you also need more energy because producing goods demands much more energy than services. And we were at that time already with the biggest discrepancy between capex on energy and demand for energy that we had for a long time. So we had that, and on the top of that, we had this perception, this wrong perception about the demand for goods and services. We also, at that time, we're looking at the cost of the green transition, and when I look back at the research and the things that were being published at that time, I guess we misestimate a little bit not only the costs, but the way in which this would translate into the economy. And the other thing is the fragmentation, which is after 2008, the fragmentation was already there, and if you take away export of digital services, it was actually there for a longer time. Then we come to the second point, which I think is a paper that Agustin published, which is at the end, we had a problem of the adaptability of supply. And there were many problems on that, but one of the things is we haven't been doing reforms for a long time in most of the countries. I actually am from a country that did some reforms during the pandemic. So we had existing problems, which is lack of reforms and this ability of living without reforms because we were in an environment of low for longer. And then we had the new problems. One of the things that also, we actually published a report this week in Brazil, is the impact of transfers on labor participation. I think we had an idea of what that would look like, but I think at least in some of the countries that I look at, we misestimated that. And we still have that impact in Brazil. We actually published a box on that in our inflation report this week. The other thing, which is François talks a lot, and I always steal the 3T, the thing that he says, which is the designing of the transfer programs during the pandemic. When we look back at what we talked about the design and what we actually did and what we have today, I think we have it in a much less efficient way than we thought we could do. The other thing is the unprecedented level of debt that we have. And it's funny because I remember going to the meeting in Marrakesh that we had last year. And I was raising this point for a long time. And I think now people are talking more about the level of the debt and the impact that this has. I think it has an impact, and I think Fabio mentioned yesterday, it has an impact more on emerging markets than on the advanced economies. But I think we are feeling some of that already. If you look at what's happening in markets lately, I think part of it is exploitation. So we need to do supply policies aimed at private sector investments. And when you look at the supply policy that we have right now, you have more participation of the public sector compared to the private than we had before. So we should be going in a different way that we're going right now. The other thing is we sometimes say the markets are behaving very well, and that means we shouldn't be worried. But part of the reason why the markets are behaving very well is because we have become the markets. We have such big balance sheets, we, at some point in time, in some of the markets, were 30% participation. And the problem with that is the prices that the market has, they have less information now because we have become so much a part of the market. And I think this is impairing what has impaired our ability to extract information from the market prices. The other point, and I'm approaching them here, is the different levels of reactions that we had to the pandemic will leave a scar. If you think that advanced economies spent 25% of GDP during the pandemic, emerging market countries spent 10, and low-income countries spent 4, we will have a scar from that, and I think there is work to be done on the multilateral organism because now these smaller countries need funding, and they don't have funding. And then to end, I think it's very important to have a harmonization between fiscal and monetary policy. This is my daily fight, and I think many other countries are also facing that. The unwinding of some of these fiscal programs are not as efficient as we understood. And to finish, I think we should preserve autonomy. It's very important. I think the autonomy of the central bank was questioned many times during this process. And I think we need to collectively preserve that because that was a great achievement of the central bank community. Thank you.
Thank you, Roberto. François?
No, first let me pay tribute to Ignazio. I was lucky enough to have this man as neighbor for 8 years in the ECB Governing Council, Visco and Villeroy. We sat next to each other. So I had Ignazio as professor for 8 years, somewhat in monetary policy. I am very grateful, but also in many other fields, medieval literature, French wines, and I could quote. You are probably aware that this man knows almost everything on almost everything. So turning back to your lecture, which I really appreciated, perhaps one remark about the past and 100% agreement with what you said, and one huge question mark for the future. About the past, Ignazio, could I sum up saying that monetary policy worked during these two very opposite episodes, these deflationary of COVID and inflationary afterwards? And it's not only a question of good luck, the reversal in supply shocks, it's also a question of good policy. And there is a tendency outside this room to say that policy did not play a role. It did. And it did through two channels. The traditional channel is through credit and demand, and it worked. The transmission of monetary policy was at least as fast as in previous episodes, and our estimate for the euro area that it contributed between 1% and 2% less inflation this year, which is significant. But there was a second channel, which was the expectation channel. And this is a newer one if we compare with the 70s, which relies on the credibility of modern central banking with three very simple pillars: independence, plus inflation targeting, plus better communication. On communication, could we say that it was a management of expectations, obviously, but not only inflation expectations, also sometimes rate expectations. And this could be a question for the debate with Ignazio and Raghu. There was often this criticism for the ECB that we raised short-term rates too late, July 22. But if you look at long-term rates and financial conditions, our communication increased long-term rates much earlier, December 21. So I think this second and newer expectation channel explains also the success of monetary policy. So this would be about the past. Let me now come to the huge question mark about the future. Are we, and Ignazio, I would be interested to have your view, are we entering a new regime? Some members of my staff said we are exiting the Garden of Eden of the great moderation we lived through till at least the GFC. But this new regime is obviously characterized by the fact that we have less demand shocks and more supply shocks. Here we all agree. It's characterized by the fact that many of these shocks are exogenous and unpredictable. Take the pandemic, take, unfortunately, geopolitical fights, and take domestic political uncertainties, including in a country I know quite well. And last remark on these supply shocks, probably most of them, or at least the predictable ones, are less favorable on inflation, demography, energy transition, and we don't know about AI. This is more open. This one could be more favorable, but fragmentation obviously is a negative supply shock. So what does it mean? Does it mean that we go from great moderation to great inflation again? I don't think so, but some people think it will be the case. I would rather formulate it this way. We go from great moderation 15 years ago to great volatility and expect a more volatile inflation in the years to come. And I conclude with this question: how should we react? We should obviously keep our three anchors of credibility: independence, plus inflation targeting, plus communication. The more uncertain the environment, the more important our credibility is. No doubt about that. But let me ask a question about inflation targeting. Should we change something if there is a great volatility? I would say there is a bad answer. Those who are advocating raising the level, the 2% level, and increasing the inflation target. If we think it's great volatility and not great inflation, it's inadequate, and it would create much uncertainty and loss of credibility. But then we have the question of flexibility. Should we increase our flexibility in a great volatility environment? To say it in blunt words, 2% symmetric does not mean 2.0% at all times. What kind of flexibility? And here these are only some personal questions. I think there is a not very good answer, which would be flexibility in space, margin of fluctuations, bands. But I say it cautiously because Claudio this morning, at least on the downside, looked interested by fluctuations and margin. But we could discuss it. I think it creates many questions. What remains is a flexibility not in space, this is about the bands, but a flexibility in time. The 2% target is a medium-term objective. We could be a bit more flexible in the time horizon. I conclude saying that this will be a good material for our strategy reviews to be run in the Fed, in the euro area, and elsewhere for next year. But grazie di nuovo, caro Ignazio.
Thank you. Andréa?
Thank you very much. Let me also start by paying tribute to you, Ignazio. I have known you for many years, the first years from far, but now it's a great honor for me to be here because your words have always been very interesting. So look, your paper and the presentation provides a very compelling narrative that can really be summarized in a couple of words, right? Central banks rose to the challenge. If you think of the post-pandemic monetary policy is tightening, monetary policy works. But what Ignazio also does in his paper, and he showed it, is he also goes back a little bit to the similarities and differences to the fighting inflation from the 70s. And I think it's always interesting to remember a little bit what happened before we can really understand what are we going to take away for the future. So there's one quote he didn't pick up in the presentation. I'm not going to make the quote, I'm going to paraphrase it. And it's from Governor Carlo Ciampi in the 1980s, so the governor from the Bank of Italy. And he basically attributes the success of taming inflation at that time to three elements: central bank's autonomy, fiscal discipline, and the role of wage adjustment. What it really was is the elimination of wage indexation. So clearly, although François, you gave three different principal ingredients, I think it's very interesting to see while central banking over the last 50 years, if you think the 80s, has changed quite radically in some respect, some principles are really timeless. So when looking back, what are the key lessons we have heard? And I'm going to take a slightly longer time period because this is, I think, one of the strengths also of your paper is providing that view. So one, we've heard it, what is really the success of monetary policy? It is the central bank independence. It is the basic requirement, but it's not just a mandate of independence. It is really to have the adequate tools to do what central banks need to do and to have the flexibility and the agility to use, to deploy the tools in a flexible way. If you look back, what has been remarkable is that central banks have not just created new tools as needed, and we all know the toolbox has been expanded quite significantly. The tools were able to be used in both directions, on the way up when needed, on the way down when needed, and in radically different scenarios. And I think this is going to be even more important going forward. What do I mean? We heard it. The inflation surge came really unexpectedly in a time when we really thought the low for long would stay for a long time, and the perception was really that was going to be a regime that would prevail for a very long time. It did not. And looking ahead, there is a risk that we may be in a more structurally more inflationary environment because of adverse supply shocks. We don't know. We also don't know what it is going to mean for inflationary pressure. But the point is, monetary policy framework need to be fit for purpose, no matter what side the inflation pressures come from. The other thing we have really learned over the last 30 or 25 years, or even to go further, is monetary policy does have limits. And I think it is by recognizing what these limits are that you really get the full strength of monetary policy. One, we've heard it, monetary policy cannot be the only game in town. And I think this is really important today. We've heard it, I think fiscal debt, right? Debt, at the time when debt is rising, it's record high. We need fiscal consolidation. We also need structural policy. Prudential policy remains at the core of what is needed. And I think that's, again, if you think of balance sheet expansion, absolutely necessary when they were deployed, also do have long-term implication for financial stability. We live in a world with much more liquidity in the markets, and this liquidity is in non-banks. A large part of it is in new markets, private markets. So this is clearly something that needs to be looked at. To finish, for the future, I think I want to go back to one point that Ignazio brought out, is you point out to these non-linearities associated with the rise in the frequency of price adjustments as a key new dynamics for inflation. And what I want to point out is a lot of the discussion in the papers were about large shocks, but it could be even more true in a world with more AI. And I think that, so that point, the impact of the frequency of price adjustment could really be very important going forward. And the question is that what it matters, or to what extent do wage adjustment matter? And I think that's going to be also, you pointed out wage adjustment didn't play a big role. It could. Why? Because we could live in a world of labor supply shortages because of adverse demographics. Could that make the pressure on wages higher? Or could AI have a countervailing force and really reduce this second round effect through the wage effect? I think that's going to be something very interesting going forward. It would be good to hear your views on this. Thank you.
John?
All right. Well, it's a pleasure to be a part of this panel. I'm especially honored to be here on the stage with Ignazio, whom I've had the great privilege to work with and learn from over the past 6 years. And Ignazio's presentation in the paper reflects a comprehensive and thoughtful analysis that's his trademark. And I agree with everything you said, and again, I think it's very deep and thoughtful. My colleagues have also covered a lot of ground. So in my few minutes, I'll briefly discuss the role of monetary policy in taming the inflation surge of 21 to 23, and some lessons from that experience for the future. Before I go any further, I'll give the standard Fed disclaimer that everything I said reflects my own views and not necessarily those of the Federal Open Market Committee or others in the Federal Reserve System. So as Ignazio discussed and highlighted, the pandemic delivered the most powerful shocks to our economies in generations. And I think this is a point that we shouldn't lose when we discuss the events of the past 4.5 years. Severe large-scale and rapid shifts in demand, along with the acute disruptions to global supply chains, all exacerbated by Russia's war in Ukraine, contributed to a dramatic rise in inflation in many advanced and emerging economies starting back in 2021. One way to see the severity of the disruptions is through the New York Fed's Global Supply Chain Pressure Index, which Ignazio shows in his paper. To give an idea of how large these shocks were, the index shot up by more than 3 standard deviations from its historical average back in the spring of 2020, then plummeted to normal levels later that year, then rose again to more than 4 standard deviations in late 2021, and then returned to normal levels last year. So as someone who studies statistics, let's put this into perspective. A single 4 standard deviation event would typically be expected to occur once every 2,500 years, based on a normal distribution. I think it's a way to capture, of course you could look at a lot of different indicators to draw the same conclusion, but it's a way to capture the extremity of the events that we were facing. Despite important differences in the sources of inflationary pressures across countries, which many have noted in discussions here, what's striking is how similar the inflation experience of advanced economies has been. For example, if I use the harmonized index of consumer prices as a comparable benchmark across countries to make this point, the rise and subsequent fall of inflation in Europe and the United States is actually quite similar. Very different reasons for it, as you point out in your paper, but quite similar. The real difference is in the US, inflation surged earlier and actually peaked several months earlier than it did in Europe. So in response to inflation's steep rise, the FOMC has adhered to 3 key principles based on decades of experience and study that have been instrumental in attaining and maintaining price stability in the past. In this regard, my remarks are going to sound a lot like François'. So I'll focus on the Federal Reserve, but I think what I say is much broader application among central banks around the world. So I think first principle was that we've clearly owned the responsibility for price stability, and we have the independence and tools to act decisively. Unlike the past, there's no finger pointing or confusion about whose job it is to ensure low and stable inflation. And history teaches us that central banks are more successful in delivering price stability when they're accountable and independent. Second, we've been unequivocal and transparent in our strong and unwavering commitment to achieving our 2% longer run inflation goal. This is a message the FOMC has consistently and repeatedly emphasized. We took decisive actions in order to achieve it on a sustained basis. And third, as Ignazio mentioned, we paid very close attention to inflation expectations and the anchoring of inflation expectations. The credibility that we built over decades of delivering inflation in line with our 2% goal has been essential in keeping longer run inflation expectations close to our target. And this has aided the disinflation process and provides more space for monetary policy to respond flexibly to crises and economic downturns. So as Ignazio's paper and presentation highlight, studying and learning from history are critically important. And by the way, if you wanted to fact check that this paper was written by Ignazio and not by ChatGPT or something, is the fact that there's a reference to ancient Greek in it, which is something we always expect from Ignazio. As Ignazio's paper, by following going back to these three key principles, they're based on both economic theory and experience for, I think, everyone in this room. And they're really the foundation, as François, you said, they're truly the foundation of the inflation targeting frameworks that many of us have adopted. I'm confident that we at the Fed, are on our path to achieving our 2% inflation goal on a sustained basis. But I also think very importantly to this issue of uncertainty and the unknown, the known unknowns of the future and all the things that we worry about. It's these principles that are actually going to be our best friends and will continue to serve as a foundation for sustained prosperity and price stability in the years ahead. Because I think one of the key lessons that your paper highlights is we didn't see these events coming, the war, the pandemic, but the frameworks and the foundations we put in place beforehand were the things that actually served us incredibly well. So thank you.
Ignazio, would you like to respond briefly, and then we can go on to a more general discussion?
I will be very humble. Well, there are many points. I think they are all well set. While you were talking, I was thinking of a few things which I did not speak about. I think the service issue is a crucial issue. At the beginning, clearly services was not responding, it was goods, but services are a very important component in the production process. If I may recall the kind of research we were doing in the late 80s and early 90s in Europe, was really the difficulty in bringing inflation down was very much dependent from productivity in the service sector being lower than productivity in the goods manufacturing, because there was competition there was less protection. And at the same time, however, in the wage bargaining, the gains that were being obtained in the industrial sector were transferred also to the service sector, and this created a kind of spiral. Now, we are not seeing much of that, but it is clear that the last mile, the discussion about the last mile that is taking place now has very much to do with the relation between services and them as an input, again, for the production of goods. So this is a relevant point. I think one of the various points that have been raised have to do with structural reforms. If there is if there is work for policies, it has to make the service sector as competitive as possible, much more than what we are seeing today in advanced economies. I know less. I mean, I'm sure that there are a lot of problems everywhere, but certainly in our case, with perhaps some exceptions in the US, but certainly in Europe, this is a very much protected sector. There has been in the making of a number of proposals, the Bolkestein directive. Many of you do not know what it is, but it tried to have a single market also for services. Well, there is a lot of opposition and special interests and so on. So this is a crucial thing. The second thing had to do with fiscal, the debt. Debt is a problem. I always thought that that is a problem also in the private sector. I mean, I'm used to our problems for the public sector, but in the private sector, if there is a risk of deflation, then the debt deflation is there that it works very much, because there are bankruptcies, because there is a kind of chain of failures. What we are facing now? Well, we are facing basically pushes on debt coming from demographics, from public debt, coming from the needs to intervene in common goods at the global level, be that climate change, be that also taking account, it was interesting, you mentioned this morning the international, the artificial intelligence effects, which have effect on inflation, effect on output. The output may be coming first if what you are thinking happens, but there is a transition. There are people who will lose jobs. What does it imply? Somebody has to pay for them. If it goes in the debt, maybe anticipating future gains that may somehow make up for that, well, there is a risk that debt, however, increases, and there is a response of markets. Now, markets have not been responding very favorable. Roberto mentioned that. But, markets can change abruptly. It's a matter really of moments, hours, and then you have a totally different world. So this has to be kept under control. Now, this debt issue is relevant exactly because it may lead to what Ken Raghuram calls an inflationary bias. That is, at the end, in order to keep pressures from the public sector, from politicians, under control, central banks may be inclined to give a little bit. There has been discussion about flexibility. This is the wrong flexibility. There is a decent flexibility, if you want, which is basically in exchange of structural reforms which have a clear effect and can make the sustainability of debts really more likely. And in that case, we may discuss what we mean about flexibility. Claudio mentioned this morning that perhaps some flexibility downward would be a good thing. I think also some flexibility on the upside may be a good thing, provided it is limited and well understood. It is not only an issue of looking at the medium term, but really communicating it well, which is very tough. I'm skeptical about skeptical. We at the end decided to do that, but about precise figures, 2%. And if you are 1.99 or if you are 2.01, then it makes a major difference. The problem is the same as point forecasts. Ben Bernanke might not like fun charts, whatever. Mervyn likes them. I think if you do them properly, they're good. But there is uncertainty about everything. And if you communicate something with certainty, then also on our policy, there are the expectations of the certainty. So I think there must be a degree of uncertainty around these things. This is a different kind of uncertainty that was talking about, that I think John was talking about. The future is really much more uncertain than what we have seen before the pandemic, the world evolving. There are major changes. It is fragmentation, trade fragmentation, it is wars, amazingly. We live in a new world of wars, very dangerous. There is climate change. There is a good thing which is called artificial intelligence or digitalization, but there is also quantum computing. There are so many special purpose technologies that are coming, and we know very little about both the positives and especially the negatives. The positives we can guess, but the negatives are the ones we should worry. Now, how do we manage all this as far as inflation effects are, which is the crucial question that I think François raised. I don't know. This is why I wanted to be humble. I remember, having studied it well, that there is a Brainerd principle for central bankers, but that is for standard uncertainty. If you have major uncertainty, I think all has to do with persistence. If these effects that we see and we understand that may, however, change relative prices, the way people work, the way the organization of production takes place, and so on, then this may be persistent. If it is persistent, we should, I think, central banks should be more alert. And that is a tough job. Thank you.
Thank you, Ignazio. Let's get into the discussion. I think just taking the central point of Ignazio's talk, which was that central banks did a pretty good job given the cards that they had. Now, if this was a public audience, they would say you're not self-critical enough. So let me ask the question: if you had to do, if you had the chance to look back with the benefit of hindsight, is there anything you would have done differently? Anybody, or let's start backwards, John.
I mean, of course, if you look back at them, like I said, these are extreme shocks. They were completely unanticipated. As we discussed and Roberto pointed out, we were dealing with things, we're dealing with a human crisis. We were dealing with a health crisis. We were dealing with a pandemic. We were all trying to learn how to model that. You mentioned the mobility issue. We were running all of these, epi models to try to figure out like what would the next wave be, and everything was, completely uncertain. I think it's very much more in the Knightian uncertainty world than that. So I feel like I go back to 2020, and if I roll back before the inflation, the downside risks to the economy, the downside risks to the financial system holding together were extreme. I mean, job number one was to ensure that the financial system continued to work, starting for us in the U.S. Treasury market and the adjacent markets, and making sure there was adequate liquidity, making sure there was that confidence that the economy would not only get through this, but come out of this, hopefully, without this kind of scarring that we had seen in the global financial crisis. So I think we were doing, in my personal view, remember there was a little comment at the beginning, I'm speaking for myself, but that we were dealing with extreme uncertainty and extreme downside risks that were right in front of us and very tangible. Over time, the data was I could have used another data point, which is the standard deviation of the shocks to the models, which are also in this 3 to 4 standard deviation way on both sides. The return of the U.S. economy was just completely unprecedented to this. So I think the real issue here was not did you get your forecast right or could you have raised interest rates a little earlier, but really managing I would say managing the extreme risks. And the extreme risks in 2020 were to the downside, and I think we did manage those very effectively. As inflation did pick up, and it was very noisy up and down for a while, but as it did, clearly the signs were picked up. We had to then switch the risk management to deal with the high inflation, and we acted decisively and rapidly to do that. So I think, in a world of extreme, I call this extreme uncertainty, I think that we were facing two very distinct risks and had to manage those. One last thing I'll just say, and this isn't a cop-out, but monetary policy is you don't get to go back in time and figure out what you would have done. You have to actually make the decisions with the information you have at the time, and I think that's why having these principles and having the credibility and all the things I talked about are actually far more important than actually the tactical decisions. What did you do at one meeting or another?
Right, absolutely. So that's why I gave you a little bit of a chance to saying that you had perfect foresight, which you don't have, and you have to act given that you don't know. But perfectly sensible answer. Andréa, you have any thoughts on this?
Look, I agree. I remember, sitting back and, talking about a big uncertainty. Like we were thinking, is it going to be a V? We couldn't even think about recovery, but is it V? Do you remember, is it V recovery? Is it a U recovery? Is it an L recovery? I can't remember if there was other letters. But it just gives, I thought central banks in general and did a very good job at being very humble, right? The forecast horizon really shortened tremendously. I think the big shock in Europe was the energy shock, which suddenly, and I think this is to me a lesson to be learned and going forward, is we can deal with financial shocks that have to deal with prices. They're tough, they're sharp. But the energy crisis suddenly faced us with a world where it could be a shortage of quantity. And that is a totally new game. And I think that would be something looking forward to be ready to deal with such scenarios, at least to think what it means in terms of response.
Which is an issue François also brought out. François?
Yes, I think your remark, Raghu and John, about with hindsight, which is a very theoretical word, is very important.
Yeah.
And this is why I'm not absolutely passionate about this debate about the forecasts which were wrong. Everybody was wrong, not only central banks, because it was a completely unprecedented sequence of COVID plus war. Each of the events was unpredictable, and the sequence was really a very tail risk. So we should use scenarios, etc., but we will never have perfect foresight. That said, with hindsight, one small lesson and one more useful one. The small lesson is that with hindsight, we could have raised rates 3 months earlier. It would not have made a huge difference, as Ignazio said, but with hindsight, it's obvious. The more important lesson is about forward guidance. And this is a lesson I take personally. We were over-ambitious, probably, in forward guidance. They were too long, and they were not enough state-dependent. So I don't say that forward guidance will not be useful for the future, especially at the lower bound, but we should use the virtue Ignazio called us to, which is humility. So it should not be too long, and it should be probably more state-dependent. The objective of forward guidance is not to forge the universe and to adapt the universe to our own will. It's to give some indications about our future behavior depending on the state of the universe.
Roberto, I'm going to skip over you, Ignazio, on this one because your views are clear.
That's a very good question, and again, I think John said it with the information that you have at the time, and it's hard to look back and do the analysis ex post. But at that time, I think we were very fast in understanding what the pandemic was going to be. I think we were one of the countries that we did that very fast. That being said, I think looking back, lowering rates to 2% was a bit too much for Brazil at that time. And at that time, what we thought was, if we are wrong, I want to make sure that I have the least amount cost. The cost is as low as it can be of being wrong. And because the credit channel was very relevant at that time, we thought, okay, if we do liquidity enough and capital enough in the banking system, perhaps we don't, and if you're wrong, and if this turns out to be like a very, temporary thing, the pandemic, then we can withdraw the liquidity and the capital, and that will cost less than lowering rates. So we actually injected 17% of GDP in liquidity and 20% of GDP in capital in the banking system. And for us, we didn't have any way to analyze what impact that would have, and it took a little bit longer. And so at the same time, we lower rates. And the mix of lowering rates to 2% and doing all these measures of capital and liquidity, the credit was growing at 27%. And looking back, I think the mix of these two, because at that time we couldn't understand the relationship between having too much liquidity and too much of a low rate. But at the end, the kind of mistake that we didn't want to make is we didn't want to turn that into a depression. So looking back, I think probably I would have done different that.
Right. So both you and John are saying extreme uncertainty. What do? You follow a risk management process, and almost inevitably, that'll be different from what you would have done with perfect hindsight. But it's not an error. It's what you need to do.
Can I just react to one thing on François? Because François talked about inflation targeting, and Brazil is a living laboratory for that, because the president talks about inflation target all the time. One thing that we experimented, and again, for advanced economies could be different, but when you do change your inflation target, what happens is the expected inflation goes immediately up to the new target, but the premium is higher than it was from the previous target. So you don't gain any flexibility, you actually lose it. And if you think that the smile curve is always positive, when you add price, you also add volatility, which means you add risk premium. So very difficult to argue that changing the inflation target will gain flexibility. You actually lose flexibility, and that's our experience. And perhaps could be different, because the point here is, can you convince people that it's once and for all? And usually, if you're telling people that I'm changing because I want more flexibility, you're not going to be able to convince anybody that's once and for all, because you might need flexibility again, right? So this is one point. Increasing the bands has the same effect, because you go up on the smile curve, so you have more volatility, so you have more risk premium. So what you can do is the time horizon, which I think we did in a way. So just wanted to react to that.
So just want to take that discussion a little more, because François raised it, Roberto commented on it. Ignacio, you get a chance now, which is, do you take more time within the bands? Do you become less religious about the downside and more about the upside, as Claudio mentioned this morning?
This is Claudio's religion.
By the way, sorry, given that you're...
Anyway.
I think that the choice between...
No, we don't. Sorry.
This is the Italian day.
Or you speak Italian, then I speak
I think that the choice between having wider bands, or also having a longer horizon with a point target, there are pros and cons, and it depends very much on country-specific circumstances. But the key point is simply to recognize that if inflation sort of somehow goes below the target, don't be absolutely concerned that actually if it falls into negative territory, we're going to lose control of everything. I mean, that's basically...
Right. Now we know Claudio's perspective. John, would you like to say something about this? I'll come back to François and Ignacio.
Dr. Visco.
Which question?
The question of how do you treat the inflation target?
Right, and this is actually something that was debated way back at the beginning of the inflation target. I remember a conference in the 90s where this idea from Bank of England economists was really, if you're doing inflation targeting, it's exactly what François said. If you have a big shock or more persistent shock, you're going to stretch out the period at which you bring it back, and you're going to try to communicate that very effectively through your various fan charts or whatever it is you use. So I think it's kind of one of the powerful kind of things of inflation targeting. You still come back to your target. You have a plan for that. You explain it, but it's context specific. So I think again, it's an idea that's been around from the beginning. But okay, so Claudio's had now two bites of the apple, as we say. In America, I mean, the obvious danger of having an asymmetric inflation target is that when you get the negative shocks we had in the decade before the pandemic, inflation runs below, inflation expectations move down, which they did in the United States pretty clearly. We had inflation running 0.5% for a decade below the target in the U.S. And doing that then causes inflation expectations to become lower, therefore less room to move on monetary policy, which moves inflation even lower. And the experience it's taken Japan decades to get out of is exactly the risk of having an asymmetric approach to the inflation, regardless of the challenges in doing this. So I think that the real lesson of inflation targeting is you want to keep inflation as close as you can on a sustained basis to your target, take the appropriate actions and the time frames to do that effectively. But the last, to me, that's the number one thing, is having inflation expectations anchored to the target, and that's whether it's from below or from above.
Ignazio?
I think the issue has to, I'll put it in a frame which has to do with flows and stocks. If you live in a flow environment, then I understand. You can somehow feel that if you go in the downside, down below the target, then you have to be careful because you could hit the lower bound and then it would be very costly, and therefore it's better really to be close to the target. But if you have stocks and if you have debt, and if debt is high, my impression, this is my feeling, was the way I try to frame my monetary policy ideas, is in that case, I think Irving Fisher was right. This is my point. And therefore, the risk of deflation is extremely high when you have very high debt. And what we were experiencing before the pandemic was for a long time inflation expectations actually de-anchoring from 2%. We were seeing them. So we were thinking of ways to get up. The big problem is that monetary policy was, as Andréa said, the only game in town. That was a problem. So QE was, at the end, something that forced us. And we had to invent forward guidance. And that was a bad forward guidance because it was unconditional. And you cannot have this kind of guidance without, somehow safeguarding from risks. So this has been a mistake. If I could go back, I would change that for sure. But really, the only game in town is the real problem. We have to learn how to dialogue with the other sides, the fiscal side, and the way the economy at large works, competition, the automaticity of response, and so on. On fiscal policy, there is a major problem. Our horizons are longer than the horizons of politicians. So we have to communicate with others and force the politician to listen to the others. It's a big skill. So not all of us, certainly not I, are capable of doing this, but this is the challenge.
Andréa?
Well, I was just going to bring in taking on my old hat when I was on the governing board of the SNB, because Switzerland is an interesting country on inflation, because it has an inflation, a really medium-term inflation target. It's between 0 and 2. But for about 6 quarters, we had negative inflation. I'm not just talking minus 0.2. I said we were around minus 1% inflation. I think it has to do about inflation anchoring and also being able to analyze the decomposition of inflation. What are the drivers of that inflation? In our case, it was clearly the exchange rate. Right, so you need to make sure and to have the confidence you can come back and it will come back. So it is about inflation targeting, but having that flexibility as a small open economy that is facing very large external shocks is absolutely important. So I'm not sure, so there is a symmetry in terms of clearly inflation goes up much higher on one side, but in the end that flexibility can be extremely important depending on the context.
François?
No, 2 very brief remarks. The first one is on Roberto's point about inflation targeting. And this idea that if you raise the inflation target, you will have lower interest rates or a less tightened monetary policy. Unfortunately, it's not only in Brazil. I'm impressed by the number of advanced economies where not the government, but some parts of public debate think clearly that if we raise the inflation target to 3%, we will have lower interest rates. It's exactly the contrary, including real, as you said, due to risk premium. Second, on this question of asymmetry, downside, I agree it's not an obvious debate. And there was possibly some excessive accommodation in the past, possibly. That said, if you look at the ECB, Claudio, we made exactly this move to have an asymmetric target. Till 21, we said close to but below 2%. So it was asymmetric. And it created problem also with inflation expectations, and now we have 2% symmetric. I think it's a progress, but I acknowledge the debate is an interesting one. Can you avoid some excess in accommodation with a symmetric target?
John? Just a quick point. We're dealing with like a lot of uncertainty. We have been for the last 4.5 years. Ignazio, you talked about the uncertainty of the future. I mean, when I think about what can we do to reduce the uncertainty, so there's a lot of things we can't do. We can't change, know what AI is going to do. We talked about that earlier today. One thing we can do very clearly is reduce the uncertainty about what our goals are. We can reduce uncertainty to the extent that we can about what our reaction function or how you think about that is. And so I feel like anytime we get into this, let's be more vague about what our goals are. Is that helping reduce uncertainty? No, it's actually adding to uncertainty. And I know there's a realism thing that was mentioned earlier. We need to be realistic about what we can achieve in the tools. But adding uncertainty to an economy and a global economy that has a great deal of uncertainty, just from a first principle, seems the wrong direction. So I think that the right answer is we should be as absolutely clear as we can about our goals and how we approach them, recognizing that within that, there's a lot of uncertainty about how that plays out. But that's why I find this issue of let's fuzz up our goals just seems to be making the problem worse, not easier. That's just my perspective.
Wonderful. Well, let's now open it to the audience. And this concludes the recorded public session.